Hey there, everyone. Welcome back to the channel. Today, we're diving into a topic that might seem a bit counterintuitive, especially for those of us who are saving for the future or just trying to keep our money safe. We're talking about why banks are cutting deposit interest rates despite high inflation. Now, you might be thinking, wait, isn't high inflation supposed to mean higher interest rates for savings? Well, it's a bit more complex than that, and I'm here to break it down for you. So, let's get started. First off, let's talk about the basics. We all know that inflation is eating away at the purchasing power of our money, right? So, when banks offer higher interest rates on deposits, it's like a little bonus for savers, helping them keep up with the rising costs of living. But here's the catch. Banks are now reducing these interest rates, and it's got a lot to do with the current economic landscape. According to experts, strong deposit growth, excess liquidity, and weak demand for loans are the main factors behind this move. Now, that's a mouthful, but let's break it down. Strong deposit growth means that people are putting more money into their savings accounts, which is great for banks. But with this growth comes excess liquidity, which is essentially a lot of money sitting around without being invested. This excess liquidity makes it easier for banks to manage their operations without needing to offer high interest rates to attract new deposits. So, in a way, the market is self-regulating, and banks are adjusting to this new reality. Now, let's talk about the demand for loans. When the demand for loans is weak, it means that people aren't borrowing as much as they used to. This is a big deal because it directly impacts the profitability of banks. If banks can't make money from loans, they need to find other ways to generate revenue, and that often means cutting costs, including the costs associated with offering high interest rates on deposits. Another interesting factor is the recent policy changes made by the Bangladesh Bank. They've lowered the policy rate and set limits on interest rate spreads, which has further contributed to the reduction in deposit interest rates. These changes are designed to stabilize the economy and manage inflation, and they're having a direct impact on what banks are willing and able to offer to their customers. Now, let's hear from the experts. Syed Mabubur Rahman, the managing director of Mutual Trust Bank, explains that lower yields on treasury bills and government bonds, combined with abundant liquidity and healthy deposit growth, have reduced the need for banks to offer higher deposit rates. He also mentions that the Bangladesh Bank's instructions to keep the interest rate spread within 4% have played a significant role in this shift. Muhammad Ali, from Pubali Bank, adds that higher deposit rates have historically helped banks attract savings. However, with excess liquidity and weak credit demand, banks are now moving away from offering higher rates. He also points out that depositors are increasingly choosing financially credible banks over those with higher interest rates, which is an interesting shift in consumer behavior. Lastly, an anonymous managing director of a commercial bank notes that weaker banks still need to offer relatively high deposit rates to attract deposits. This highlights the competitive nature of the banking industry and how different banks are adjusting their strategies to stay afloat. So, what does all this mean for us, the savers and investors? Well, it's a bit of a mixed bag. On one hand, lower interest rates might mean less money in our savings accounts, which could impact our long-term financial goals. On the other hand, it also means that banks are more stable and less likely to fail, which is a good thing for the overall economy. It's a delicate balance, and it's important to understand these dynamics as we navigate the ever-changing financial landscape. In my opinion, what makes this whole situation really interesting is the interplay between consumer behavior, bank policies, and economic factors. It's a complex web, and it's fascinating to see how all these pieces fit together. What do you think? How do you interpret these changes in the banking industry? Let me know in the comments below. Well, that's all for today's video. I hope you found it insightful and thought-provoking. Don't forget to like and subscribe, and stay tuned for more in-depth analysis and commentary on the world of finance and economics. See you next time.